Okay, so let us continue from where we had left in the previous session. So we were discussing about the group audit, and we will have one quick recap of what we have learned, and I hope at least you also please make a note, because I'll give you a structure to the points what we had discussed. Okay, so when we talk about a group audit, you can make this as a mind map. So primarily we speak about the three concepts. One, basics of consolidation. So what did we learn in basics of consolidation? One, we thought, is it mandatory? Okay, the concept number one is mandatory. Is the CFS mandatory? So we have got exemption 1, exemption 2, exemption 1 your intermittent parent, exemption 2 is a government exemption, exemption 3 is your investment entity, and exemption 4 you have got the that temporary control. Then we discussed about the point number 2 is about the responsibility of management. So management has got a responsibility to prepare and present the financial statement, then to identify the components, then to obtain, give the complete information, then appropriate adjustments, and then gap conversion. So we can say these are all the 5 responsibilities of the management. Now responsibilities of the auditor. So auditor has to see, one, true and fair. Second, check whether the consolidation adjustment have been carried as per the framework. Section 143 inquiries, section 143.3 reporting requirements, and validate the requirements of CFS. Okay, check whether they have done as per the applicable standard. Now, this is all about your first concept, where we talk about the basics of consolidation. The second thing, what did we discuss? We discussed about the performing audit. We can call the heading like this: performing group audit. So what is your considerations while, or what all the activities you are supposed to do while performing group audit? So first concept is about the acceptance, engagement acceptance. So when you talk about engagement acceptance, one, you have got financial reporting framework, whether accounting standard or Ind AS, SA 600, whether it is applicable. Are you a subsidiary auditor also? Is there any other information? If any of the entity is not having the same closing period as your 31st March. Okay. Then what is the second thing? Plan and perform. Okay. So first thing, what you come across is the planning. So you have to do the planning. And while doing planning, you have to consider the structure of the group, accounting policies. Okay. So accounting policy, group structure, then nature, timing, extent, coordination with the group auditors, then materiality. You have to consider materiality. So materiality used for the group evaluation, then it is used for the modification, evaluation of the modification, scoping of the component. So this is the points related to materiality. Third, you need to check the completeness. Okay, how do you know about the completeness? One, review the working papers of the last year. Second, check the parents' procedure, review their investment, review the statutory records, then review the any arrangements which they have done, which is keeping outside this like special purpose entities, like special purpose entities. Okay, after you have verified the completeness, you can check about the understanding of the relationship or control. Understand controls. Okay, how do you know? You can know the board of directors meeting, agreements, statute, technology know-how. Is anybody provided technology know-how? So these are all the points we'll tell you. See, these are all the points at a high level. See, students, when these side points you remember, at least 70 to 80% of the test exams are covered. So they will be asking any one among these. So once you understand the flow, then it is done. Then you need to, fifth one, you can write the points. Fifth one is your exemptions. Examine exemptions. So how many? So what you need to have? You need to check the reasons for exemptions. Okay, there can be 4 types of any types of exemption they could have acted, and look for the reasons. That's it. Examine the exemption. So again, they have told about the same. Now check the changes in the state. 6.1, we can write change in status, whether subsidiary has turned into associated turned into subsidiary. 7, consolidation method of consolidation. So there are 3 methods: line by line consolidation, equity method, pooling of interest method. So you have to see how it is applied, or okay, what changes they have done. Okay, so those things you need to check. Then the 8th one is very important. We can say consolidation adjustment. So primarily we have got 2 adjustments called permanent adjustment. Permanent adjustment has your goodwill and your NCI. So what you need to check here, okay, how the goodwill is calculated, on which day the acquisition happened, pre-acquisition reserves have been properly allocated. Okay, so this is what you need to check. The second one is your current period adjustment. So current period adjustment includes your intercompany eliminations, indebtedness, subsequent events, subsequent transactions, foreign components gap conversion, negative balance of the NCI, etc. Now, what is that you consider for current period? Okay, check for the memorandum of records where this adjustment journal entries are done. Review the current period adjustments. Check all the entries are done. Okay, intercompany eliminations are deleted. Test for impairment of the goodwill. See, because it's also part of your current period adjustment. Then you look for the NCI balance change. Share of profit has been allocated to them. Next, you check the financial statement date adjustments, that 6 months or 3 months. Okay, so this is where, and last thing you need to check for the disclosures. Okay, this is where we had discussed up to here. And next one, one more point, number 9, you may have to take the management representative. Okay, this is not this point, this is this point, point number 9. So you may have to take the management representation. So if you remember this, then done. See, this is the majority. This is the biggest portion. Like we see, every chapter, there is one particular element which is the heart. Like in digital audit, that identification and assessment of the digital risk in IT environment risk is the heart. That means majority will be revolving there only. Other things are very small things. Like this, in this chapter, the biggest portion is your planning and performing. Okay, so you have see so many flows, then current period adjustment, how do you verify it, how do you take the representation of the management. Last part, your concept number 3 is your reporting. So we have got 5 types of scenarios for reporting. We'll see that. Yes, I hope it's clear. You can make a note like this only, whatever points I have suggested, you keep in that line only. So that once you have this flow with you, that these are all the procedures, these are all the 3 concepts. Concept 1 is basics, where exemption, responsibility and responsibility will discuss. Performance includes primarily 2 elements: engagement, acceptance, planning and performance. This I have kept as line with the your SA 800 series. Performance will have your starting with the 300, 320, understanding of the completeness. Yes, so like this. I hope it's fine, students. Simple. No, because I am finding group audit is a very simple chapter. Thanks to India's 110. Okay. Now, what about the disclosures? We have to verify the disclosures in CFS. Now, one very important question comes. What disclosure should I give? Like I have got 20 subsidiaries. Every subsidiary have disclosures in their notes to account. Am I supposed to repeat that in CFS? No. So, Ministry of Corporate Affairs gave one circular. They said that, look, you need not repeat all the disclosures of the separate financial statement. I mean, there is no point. Already, if anybody wants, let them take the annual report of that subsidiary and just let them check what disclosures are required, are done there. So, what disclosures you need to give is only what is relevant to CFS only. If it's relevant to CFS, yeah, you give. So, what all the disclosures audit shall be given in the CFS? Now, the auditor should examine that notes are required by the applicable standards which are necessary in presenting true and fair view are included. That means whatever your applicable accounting standard or Ind AS requires some disclosures, like Ind AS 12 requires some disclosure for CFS, 110 requires for DFS. So whatever relevant standards talks about the disclosures, you disclose that so that true and fair view can be found out. Look, if the statutory informations disclosed in the SFS, if is having a bearing on the true and fair view, that also may have to be disclosed. For example, section 143 says that you have to report transfer of fund to investor education and protection fund. Like say, for example, one of the subsidiaries has made a default in transferring the fund. Now you have to think, okay, this is one of the statutory information we are supposed to give. Is this having a bearing on the true and fair view, this non-compliance by one of the subsidiary, if it happens to be a major subsidiary? Yes, in such case that has to be disclosed in CFS also. That means something disclosed in the standalone should be given in CFS. Further, Schedule 3 general instructions for specifically for preparation of consolidated financial statement also need to be disclosed. See, the point is very simple, students. What they are trying to tell here, you need not repeat the disclosures of all the standards, but if any particular standards require disclosure, that has to be given. Statutory information having bearing has to be given. Schedule 3 disclosures for general instructions, okay, has to be given. Now, following information is also to be disclosed in the CFS separately for the parent and each of the components, like amount of net assets and percentage of consolidated assets. Who is telling you this? Schedule 3. Because you have got part A, part B and part C. The third part talks about the CFS related disclosure. So this example is pertinent to point number C. Amount of share in the profit and percentage in the profit and loss of the consolidated P&L, amount of OCI and the percentage of OCI. See, it looks like this. This is part 3, general instructions for the preparation of CFS. If you open Schedule 3 of the Companies Act, part 3. Okay, it's not ABC, it is part 1, part 2, part 3. Part 1 is for your accounting standard, part 2 for Ind AS, and part 3 for your CFS. So, part 2 or part 1 will be applicable to CFS, the format, the presentation, but some additional disclosures are required for Schedule 3, part 3. What is that? You have to tell name of your parent, subsidiaries, Indian and foreign subsidiary breakup. What is your net assets total? And what is the percentage of this particular parent in the total consolidated asset? And what is the amount? What is the parent's share of profit in the total consolidated profit? And what is the amount? What is the parent's total OCI in the consolidated OCI? And what is the amount involved? Okay, so like this is how you need to disclose. This is what they have told here. See, following information need to be disclosed as per CFS, which is that Schedule 3, Part 3. Amount of net assets, and net assets as a percentage of total assets. That means how much each of the subsidiary, what is the amount of, and what is the percentage to the total. Amount of P&L, and how much is the percentage to the total P&L. So, for example, if the consolidated P&L account shows the total profit of 500 crores, out of this 500 crores, how much parent is contributing? 250 crores. So how much percentage? 50%. Subsidiary 100 crores. So how much is the percentage? 20%. So like this, they have to give the breakup of every asset wise, OCI wise and P&L wise. Okay. In some circumstances, no separate disclosure will be required. Okay. One of the circumstances, Ind AS 110 does not give a list of information which is part of SFS but need not be reported in the notes of the CFS. However, based on section 129(4) MCA circular, you can understand that only relevant disclosures should be given. That means in 110 is totally silent. It doesn't tell you what to give, what not to give. Okay, it is your judgment. You need to decide whichever relevant information is there that you have to give. Now, based on the above discussion, in case of companies, following informations of separate financial statement need not be included in the CFS. So this is very important. I think this has come for your exam, MTP. So please mark this very important, students. So you are doing the audit of group audit. In that you are auditing it. While you are auditing, you have done the consolidation adjustments, you have seen the completeness of the information, you have done the planning, materiality, okay, goodwill impairment, everything you have done. Now you are verifying the disclosures. So now you understood one thing, that relevant disclosure has to be given. Now, some information need not be given. That means this is part of SFS, but not part of CFS, which is openly told. Okay, what are those disclosures which is not required? Source from which bonus shares are issued, like which capitalization of the profits or reserves were done from the securities premium account, or whether it is issued out of the free reserves or from securities premium. Why this is not required? See, suppose one of the subsidiary has issued bonus shares. Now, generally whenever you issue bonus shares, you need to tell, okay, because what is the journal entry you are going to pass? You are going to credit to equity share capital, debit what? Share premium account or general reserve account. And you need to give the notes to account that bonus shares have been issued and it has been issued out of the share premium of reserves. But if this has been issued by any parent or a subsidiary, that will be disclosed in their standalone SFS, but not in CFS. What is the reason? Because due to the elimination of the reserves of the subsidiary, they will lose their relevance, because the subsidiary's reserve, unless you follow pooling of interest method. In pooling of interest method, every reserves you transfer in the CFS. But if you are not following pooling of interest method, all the reserves and surplus of the subsidiary, you are going to eliminate it. So because of this elimination, they don't have any more relevance in the CFS. I hope it's clear, students. No, you have doubts, please can ask me. Now, all the unutilized money out of the issue, indicating the form in which such unutilized funds have been invested. Now, investments made using these funds are eliminated, because whatever investments are unutilized money out of the issue, that means you have made a shares issue. What is the journal entry you are going to pass? Bank account debit to equity share capital, and that money is still lying with you. Okay, so now since share capital you are going to eliminate, and also at the group level these funds are aggregated and consolidated with other assets, they lose their distinct identity as unutilized money from the issue, because this bank balance will be clubbed with other bank balance. So at the group level, you need not give a separate disclosure, okay, how much shares have been issued by this one of the subsidiary and how much money is remaining unutilized. Third, disclosure required under MSME MED Act. Okay. Now at the intermediate level, you might have come across there are some disclosure requirements. How much interest is delayed, how much principal is delayed, okay, how much interest you have paid on the outstanding balance. So there are some MSMED Act required disclosure, because this is relevant only at the entity level where actual cash flow happens. At a CFS level, no cash outflow or inflow happens. That's why they said that no, let this disclosure of MSMED disclosure, let it happen only at the SFS level. At CFS level, not required, because it doesn't add any value by giving such a disclosure, because there is no cash outflow or inflow happens. Now, a statement of investments, whether shown under financial assets or non-financial assets or stock in trade, okay, so it's not required, because investments are going to get eliminated from the CFS. Now, generally in their investment will be classified as trade investment, and names of the bodies corporate in which the investments have been done, nature and extent of the investments. See, all these disclosures are required in the SFS if you have done any investment. But since at the group level, that whatever investment you have done in the subsidiary is going to get eliminated, this disclosure of SFS is not required at CFS. Now, value of imports calculated on CIF basis, your schedule 3 requires some disclosures. Okay, so you need to tell how much is the import on CIF basis, because particularly they want to track the dollars. Okay, who government of India. So they always see that how much imports you have done on the basis of company during the financial year. Now, what happened? Suppose if your subsidiary is sitting in a foreign country, lot of intercompany transactions must have happened in the foreign currency, and this also will get eliminated. Providing the import figures without any corresponding expenses may distort the figure. That's why what they said, look, if you have imported something in dollars, okay, disclose in your SFS. But such items need not be disclosed at the CFS level, because again, no cash outflow happens. So someone can, because it can simply overstate, it can simply, because there may not be any relevance of that information. Because if the government wants, they will go to the SFS level and figure out this. Okay, so the raw material, components, spare parts, and the capital goods. Now, expenditure in foreign currency during the financial year on account of royalty, again, see, dollar outflow, professional fees, consultation fees not required, because again at the CFS level, no cash outflow happens as such. Value of all the imported raw materials, spare parts, components consumed during the year, and value of all the indigenous raw materials and percentage. Like if you have used some raw material, how much is the imported percentage? How much is the local purchase percentage? Okay. Even this disclosure you have to give at SFS level and not at CFS level, because again, no such cash outflow inflow happens. The amount remitted during the year in foreign currencies on account of dividend, with the specific mention of number of non-resident shareholders, etc. Again, they may have elimination can happen or no cash outflow happens at a CFS level. Again, not required. Earnings in foreign exchange classified in the following heads, like how much did you earn based on export of goods, royalty, interest, and other income? Because again, no inflow happens of dollar at CFS level. So they government decided again not required. So these are all the 9 disclosures which may be required at SFS level but not at CFS level. So there is one MTP question based on this. Let us see that what they are going to ask. Okay, so you may have to shift it because I had given it as a question number 10 by mistake. Now PTK Limited holds 51% of the equity of ABC and 61% in XY. There are various informations and explanations which are disclosed in respective companies in the notes to the financial statements. At the time of consolidation, okay, you are clear that they are talking about chapter number 13. PTK has consolidated the informations and explanation disclosed in the notes as well as. That means whatever notes in their standalone financial statements were there, they consolidated at the CFS level. However, the principal auditor is having the view that only information and explanation which is relevant at the group level only has to be given. Yes, principal auditor is correct. Management is not correct. Simply they are putting so much information which actually may not be good also. Okay, because it can distort the real information which is really relevant. Now, please mention any 5 aspects given in the notes of separate financial statement that need not be included in the CFS level. Now, who decided it? Circular issued by the MCA decided. Now you can write any 5 points: bonus, unutilized money, MSME payments, okay, import or your export happening in the foreign currency. So any 5 points you can study and write. Yes, I hope it's clear. So this is one of the important thing you may have to make a note. And the last step for you, okay, what is this 9th step? What is your first step? Your first step is to make a planning. Second step is to figure out the materiality at the group level. Third is to check the completeness. Fourth, understanding the relevant control, whether it is a subsidiary, associate, etc. Check the exemptions. Check the change in the status. Method of consolidation adjustments. So which has got permanent adjustments and current period adjustment. And the 9th step is to take a representation. With this, you are done with CFS audit. So next is your reporting. Okay. Now, what is that representation you should take? Very important and very simple actually. So SA 580 requires a representation to be taken from the management. So at the CFS level, auditor should obtain evidence about the management has acknowledged their responsibility for true and fair presentation of the CFS. This is the first acknowledgement. In addition to it, they have to take on certain other matters also. Which are those other matters? One, completeness of the information. You go back and check, students, the responsibility of management. See, completeness is their responsibility. Identification of reportable segment, identification of related parties, appropriate adjustments. You see, these are very easy to answer if you have understood the responsibility of the management. So there were 5 responsibilities. Same thing you write as a representation. You take the representation for responsibility, completeness, reportable segments, related party, appropriate adjustments. I hope it's simple. Done. Yes, let us see. Kajal Gupta is nearing the completion of audit of a CFS. See, audit of CFS. Keyword. She requires written representation. So you are very clear. This is from the concept number 2. Okay, sub concept number 9. From the parents management on the matters material to the CFS, specific matters you need to take. One, you need to take about the responsibility of the management, then completeness of the information, identification of related parties, etc. Yes, I think these questions we have done. Question number 17 we must have done, right? Yes. Yeah, we have done this because I told you to mark important also. Yes. So the last part of our this chapter is about the reporting. Yeah, just 1 minute, friends. Yes. So we'll move on to the last part called the reporting. Okay. Now, what is that reporting considerations? Now, there could be two situations in an audit of CFS when parent's auditor is also the auditor of all the components. Absolutely no problem. Plus SA 600 not applicable. See, this is a very ideal situation because you are the auditor of a parent also, you are the auditor of subsidiary also. No coordination issue. You exactly know, you only have signed that subsidiary. But the biggest problem comes when the parent's auditor is not the auditor of one or more of the components. Therefore, you may have to use the work of other auditors. So when you are preparing the report, the standards on auditing SA 700, 705, 706, okay, you may have to consider. So that means yes, even CFS also, the audit format and all will go in the same fashion. Where the work of other auditors are considered, SA 600 also becomes important. So there can be 5 situations of reporting. One, parent auditor is also the auditor of its component. This is scenario number 1. Then parent's auditor is not the auditor of its component. This is scenario number 2. Okay, there can be another situation. Okay, irrespective of whether you are the subsidiary auditor or you are not the subsidiary auditor. Here, the situation is the subsidiary's accounting framework is different. Then now another question comes, who is that subsidiary's auditor? It can be you, that means this is applicable. It need not be you, that means this too becomes applicable. I hope it's clear, students. So generally, these two scenarios will come because when the reporting framework is not same, suppose if that subsidiary happens to be in India, then of course your reporting framework will same. India becomes applicable. But if your subsidiary happens to be in Philippines, in UK or in Uzbekistan, their accounting framework becomes applicable. Now tell me, is it possible that you are the same auditor of that company also? No, the chances are very high. The situation could be when the framework of the subsidiary is different, you may not have been the auditor of the component. In this case, these two requirements becomes applicable. Okay. There can be another situation, situation number 4, where components auditors report under auditing framework different from the parent. That means when we have done the audit, we have done audit under SA and they are giving under ESA or maybe another framework. And the 5th scenario with the first case study which we spoke about, where the component is not audited only. So how to address these issues? Okay, so let us see one by one. These are all the 5 cases and very easy. You have to understand. So what is your reporting procedures and responsibilities when parent auditor is also the auditor of its component? Now, this case is a very simple and straightforward case. Drafting the audit report. While drafting, auditor should report whether the principles and procedures for preparation of the CFS as per the accounting standard or Ind AS have been followed. That means first thing you need to say, have they covered with all the standards? Did you come across any observation? If there is any departure, you may have to modify the opinion. Auditor should issue audit report expressing an opinion whether it is true and fair view. Okay, if you see this is in line with your auditor's responsibility. First thing you have to check whether you have complied with the applicable reporting framework. Have you done the consolidation as per AS or Ind AS? 110. Accordingly, you have to if not, you have to modify. Second, you have to express an opinion called true and fair, where consolidated cash flow statement is also included. You should also express opinion on true and fair view of the cash flow. That's it, done. Nothing, no other special consideration. You see, so easy. I don't think so they can ask you this question, or maybe for 2 marks they can ask you. Okay. Now, as another scenario comes, what if the parent auditor is not the auditor of the subsidiary? In such cases, automatically SA 600 should strike to you, and auditor should consider SA 600. Then, now you start writing the contents of SA 600. Now, if it is necessary to make a reference, then auditor should tell in the other matter paragraph the magnitude of the portion of the financial statement which is not audited by you. So this is what we have already learned in SA 600. You have to, in other matter paragraph, you have to tell like so much subsidiary, I didn't do the audit. How do you do it? This may be done by stating aggregate rupee amounts or percentage of the total assets or revenues which is not audited by the principal auditor. So how much portion you didn't do? So you can tell either amount wise you can do, or you can tell percentage wise of the total assets or total revenue or total cash flows. So we didn't do. Now, total assets, total revenue or cash flows not audited by parent should be presented before giving effect to the permanent and current period adjustments. That means before you do any adjustment, that means plain balance sheet only you have to take. Each person's assets you have to take. Like for example, parent has a total assets of 100. Subsidiary 1 has got a total assets of 50. Another subsidiary has got a 10. Another has got 40. Another has got 20. So what is the total assets now? So out of total assets 100, 150, 60, 220. Total assets is 220. Now, which one you didn't do? Say for example, these two things you didn't do. So 60 is what you didn't do. So you can tell either 60 by 220. That means you can say 27% of the consolidated assets we didn't do audit. So X and Y was done by so and so person. But what about the intercompany elimination? So many intercompany transactions must have been happening here to here, here to here. No. When you talk about the percentage which you have not done audit, it should not be considered. Okay, so it is before taking that intercompany adjustments. Now, reference to the report in the auditor's CFS that you didn't do the audit does not constitute to be qualification, but it is just an indication of division of responsibility, and you are going to state in other matter paragraph. I think students, this is also very simple. That means under any circumstance when you are not the auditor of the subsidiary component, you have to just state that fact in your other matter paragraph, comply with SA 600, and that reference is not considered as a qualification. Okay, I hope it's fine. Can we proceed further? Is it simple? Okay, next one you please understand carefully. This is the actually the heart of this reporting part. This is you need to learn, practice by writing. Okay, I will explain you the procedure at the same time as and when we discuss. When the components audit report on the financial statement, you have done accounting framework different than parent. So definitely who would have done this audit? A foreign auditor would have done. That's why automatically this also becomes applicable. Chalo. Now what they are trying to tell that parent is following Ind AS and subsidiaries financial statements is in UK GAAP or IFRS. Let us take all GAAP and all instead of we will take IFRS. Now, is it same? No. Maybe there are some carve out adjustments, something which is applicable in Ind AS but not be applicable IFRS. So can we take the IFRS financial statement as it is and line by line do the consolidation with Ind AS? See, today's date may be much possible, but what if it is accounting standard versus IFRS? No, it may be totally different. Now, how do you do the reporting now? How do you do the audit? Okay, now you please see here, understand it. A parent may have components in the multiple geographies which is outside India. I told you, no? That's why they follow a GAAP which is different than the parent. Like parent is following accounting standard, that subsidiary is components following IFRS. Foreign components prepare the statements under different reporting standards like US GAAP or IFRS, as per the jurisdiction of the component. Since you are situated in say UK, you have to prepare a balance sheet and P&L account as per IFRS. Why? Because you need to file it with the local jurisdiction there, their ROC or government, whoever. So you can consider these are all the points. So the local component auditor may be unable to report on the financial statement as per parent's GAAP because of the unfamiliarity. Now you tell me, students, see here. You have got a subsidiary in UK and this balance sheet is prepared as per IFRS. Now parents, this is subsidiary. Parent has prepared the balance sheet in accounting standard. This is parent, accounting standard. Now can you prepare a CFS and do line by line consolidation? Not possible, because their adjustment may be different, our adjustment may be different. We may have Ind AS 116, they may not have Ind AS 116. Now what to do now? So can we tell subsidiary that prepare one more balance sheet as per AS, which one? UK subsidiary. We will translate it as per accounting standard and then we will consolidate. Okay, we can tell, but do you think that local component auditor, the UK chartered accountant, is he aware about accounting standards? May not be. Okay, so when the component's financial statements are prepared under the accounting framework, which is different from the parent's framework, parent's management performs a conversion of components audited financial statements as per your framework for the CFS. Now the conversion adjustments are audited by the principal auditor. So what is that they do now? So since you are IFRS, so we will prepare some document called a gap conversion. These are all adjustments. That means if my PP as per IFRS and AS is same, so we will not bring. But my intangible asset as per IFRS is totally different from here. So I will start here that, okay, this is one IFRS intangible asset adjustment. I say from our financial it should have been this amount. Okay, so now what I will do, parent will audit, take these two documents together and then they arrive at the intangible asset value. So he will take the intangible value from here, plus or minus he will do it here and calculate this value. So this is something called a gap conversion. I hope you are clear, students. I hope it's perfect. So one of the option 1 is IFRS financials are already prepared and audited. I will just to do one gap conversion document. I say how these adjustments are different between two, and we will hand over IFRS balance sheet plus gap conversion balance sheet to the principal auditor. What principal auditor will do? He will see if there is no gap conversion, like deferred tax, no gap conversion. So I will take the value as it is. But stock, there is some gap conversion adjustments, plus or minus. I will take this value plus this value and put this value, stock value here. So this is your gap conversion adjustment. This is called option 1. Alternatively, I could have done one more thing. What is that? Why not let me prepare another financial statement as per accounting standard only? Complete accounting standard balance sheet from the same data. Okay. But now question comes, who is going to audit? That's why what we will do, we will have one group accounting manual which is designed as per accounting standard. Now this assignment becomes a special purpose framework for the UK auditor. I hope you are clear. Now we will go back to the UK auditor and management will prepare the accounting standard based financial statement in dollar. Management will prepare accounting standard based financial statement in dollar. It will go to the UK auditor and say, sir, please audit this accounting standard based financial statement. Now UK auditor will get confused. You say, what is your benchmark? On what basis you are prepared? And we say, this is prepared as per this group manual. And we will hand over that manual to them. And this group manual is based on accounting standard. Now, this becomes a special purpose framework audit. So he will see that, okay, these numbers are properly calculated as per the group manual, and he will sign and say that, look, we have done the audit as per the group manual. So this is special purpose framework. This is meant only for the management, not to be used elsewhere. And this is used for the consolidation. So he can alert the users, he can restrict the distribution. Now what happens? Now I will get one accounting standard balance sheet certified by the UK chartered accountant. I don't have any gap conversion. Straight away, I will take these numbers and add and prepare the CFS. I hope it's clear. So, if the management is going to prepare the group accounting manual, the group manual contains all the accounting policies consistent with the framework of the parent. So then the local component auditor will audit and issue the audit report prepared as per the group accounting policies under special purpose framework. Now, parent's auditor should perform the procedures and determine compliance with the group accounting policies. Okay, now they are going to get the group accounting standard financial statement. Now, this ensures that information prepared under the requirement of group accounting policy becomes directly usable. That means you no need to do any adjustment. Take it, simply consolidate as if that entity is sitting in India. So, eliminating the need for differences between the basis of the components financial statement and that of the CFS. Friends, I hope you are very clear. Perfect. Any doubts you can ask me. You are able to visualize, right? You are able to understand how the consolidation of a foreign entity is going to happen. Okay, last two are very simple. When the component auditor's report under an auditing framework is different than that of a parent. Okay, here there is nothing much. 1 mark question they can ask you. Normally, the audit of financial statement should happen under generally accepted auditing standards in India, which is which is SA. When I studied, it was AAS, Auditing and Assurance Standards. Today, we have got SA. So, in order to maintain consistency, any of the components financial statement which is audited under different framework, you have to re-audit it under Indian GAS. That means SA. Anyhow, after today, our SS are ESA based. This was the biggest problem when AAS was there. But today, since everybody across the world is following ESA based, in fact, what you are all learning in the standards on auditing is ESA based, this problem generally do not come. Okay, now let us see one test your knowledge 7 question. You are appointed as the auditor of Najib Limited, which is a listed entity, which is a main supplier to the USA building and construction market. Now the turnover is 1.9 billion, operates through 11 business units, 170 branches. As an auditor, how will you draft the report? Okay, they are talking about the reporting requirement, concept number 3. When the component auditor reports on the financial statement under framework different from that report. So from you understood chapter 13. When the component auditors report under auditing framework different from the parent. Okay, so same points we are going to report here. All these things what we have just discussed. Okay, point number 3, accounting framework. Okay, I can explain it here. Okay, this is the same point we are talking about. So let me explain again. See, this is the parent. We will draft the parent's balance sheet as per AS, accounting standard. Now, this is one of the subsidiary. This is parent. This is subsidiary as per IFRS, balance sheet as per IFRS. Now, I need to prepare one CFS. This is my CFS. Now, when I prepare CFS for the parent, what should be the framework? AS. But my problem, biggest problem is one of the balance sheet is in IFRS among all the subsidiaries. Okay, let me take one more example where I have got subsidiary 1, subsidiary 2, which is having a balance sheet in AS only. I don't have a problem. So how do I do audit consolidate? See, if I have to add a PPE, so I will take PPE 10, PPE 5, PPE 7. So if forget about subsidiary 1, if we had only parent and subsidiary 2, what is the PP I would have written? 17 I would have written. Followed? Okay, but since I got subsidiary 1 also, should I not add subsidiary 1? Yes. So how much should be my PP? 22. But wait. Today this problem does not come, but for simplicity's sake, I'll give an example. See, when you talk about PP, your Ind AS 116 says that decommissioning liability should be part of PP. That means when you recognize a PP, you should have passed one journal entry at the beginning PPE account debit to decommissioning liability provision account, present value of the future cash flows. And let us assume this amount is 2. Okay, for whom? For the foreign subsidiary. We have done it. This adjustment is done here. The decommissioning liability is included here. Decommissioning liability is included here. But the decommissioning liability is not included here because they, for example, their gap doesn't require that decommissioning liability related adjustment. Okay. And what was that entry they were supposed to pass? This was the entry they were supposed to pass. Did they pass? They didn't pass. Now, is it okay that if and what is the amount? 2. If they would have passed this entry, what would have been their balance? Their balance would have been 7. You got my point? So now I cannot simply say 22. No, 22 is a wrong number. Why? Because 10 and 7 are perfect because this decommissioning liability entry you passed. But that 5 is a wrong number because it is missing decommissioning liability. One of the examples, simple example. Okay, now how to do this now? Audit, how to do the consolidation? Okay. There are 2 methods to do the consolidation. Let us take the method number 1. In the method number 1, I will have one more document here called gap adjustment. I will call it as a gap adjustment. Now, in this adjustment document, I am going to write all those elements which is different treatment I have given because of the different gap. Now, I know that I should have done one accounting entry for 2. I missed it. So now what I will do now? I will do that PPE adjustment towards decommissioning liability 2. And I say that this is missing in IFRS balance sheet. Okay, now who will certify this? Now we can ask that local auditor, okay, who audited this financial statement only, please sign this. Okay, now I have got 2 documents. One, subsidiaries IFRS balance sheet and subsidiaries gap adjustment document. It's not balance sheet, where adjustments are written, wherever there is gap adjustments. Now, what I will do, how do I do consolidation? Okay, now I need PP. So PP, how do I consolidate? I will consolidate like this. You see here, I have to consolidate PP now. I say PP parent, how much? 10. Then subsidiary 2, how much? 7. Is it correct? Yes. Subsidiary 1, how much? 5 plus gap adjustment of subsidiary 2. So total how much comes? 10, 17, 22, 24. This is my consolidated. This is one alternative. Alternatively 2. So I hope you are clear. So this is one new line item comes called a gap adjustment, or which is coming from here. Alternatively, what I could have done, I will scrap this because this document will be used to give to the ROC of UK. Now I need to consolidate now. So I will prepare one manual. This is a manual. How need to be accounting has to done. So there PP accounting, I say decommissioning has to be added. Now the UK auditor says, what is this adjustment? Because their accounting practice may be different. Then we explain them, look Baba, in India, our rule is that we have to add the decommissioning liability, find out its present value and add to the PP value only. Okay. Then another balance sheet is prepared now, where in UK, this balance sheet of subsidiary 1 is prepared in AS. There PP is shown at 7 only with adjustment. Which adjustment? With your decommissioning adjustment. Now this auditor will sign this financial statement, but in the report he will say that this balance sheet is a special purpose framework applicable for it. So this is prepared for consolidation purpose, but for others it may not be suitable. Okay, now how the consolidation is going to happen? Okay, I will take the parents 10, subsidiary 7 and subsidiary 1. I will not refer this anymore now. This is no more relevant. This is not available, but instead they opted for this. No, I will take this PP balance 7 from here. 7 from here. And total, I say my PP is 24. See, in both the places, you are going to tell PP 24 only. But the way you consolidate it, the persons who audit it, the method they follow may be a bit different. I hope it's clear. Thank you for the question. No, I'm feeling good because this example didn't strike me when I was preparing. So when you asked me, okay, it struck me, okay, better. See, this need not be a perfect example, but have you understood the underlying concept? See, whenever we talk about an analogy or any example, it need not be, okay, perfect. Our objective is to know, okay, how the concepts work. So last is, okay, then this is what they have told here. So you have alternative, you can do like this, you can issue a report like this. And when the compo is different, you have to do again audit as per the Indian framework. That means again, I told no, these are all the points. See, when we talk about the guidance notes on group audit, see, guidance notes on group audit came long back. Okay, maybe 1980s or 1990 it must have come, where Indian gap was different, US gap was different. But after 2013, is we have every countries in the world have converged with IFRS. See, today we speak single accounting language across the world. So this is not much practically relevant here because very few adjustments would have been there. And today, and for your information, see, you're all so fortunate. The day you understand Ind AS or SA, literally your profile is global. That means any country you can go, you understand the accounting. Any country, in 190 countries, you go any country, you understand their accounting, you understand their auditing. See, this is the advantages accrued after 2018. Okay, those people who cleared CA before 2018, they are still in accounting standard only, and it's very difficult to learn. Okay, but you see, today you have learned the global language. Yes, next, components not audited. Okay, what if you are not audited the component only? Yes, generally the component should be audited. Such audit or audit procedures can be performed by the auditor or by the component auditor. Where the financial statements of one or more components remain unaudited, you need to modify the opinion because you didn't get the sufficient appropriate evidence. You remember the first do you remember, students, the first case study where US was not audited? Yes, so auditor has to, see, you can write a point, it should be audited. If not, you have to modify the opinion. So auditor has not obtained sufficient appropriate evidence. And third, you can write, you have to evaluate both qualitative and quantitative factors. Okay, using guidance provided in SA 705. Like, why you didn't audit? Okay, what is the possible effect of not auditing? You cannot simply issue disclaimer of opinion there or qualified. You should see what is the possible amount involved. Okay, about unaudited amount. That's it, students. So with this, we are done with this chapter only. Okay. Okay. So let us see some of the questions, test your knowledge question. You are appointed as the auditor of Nawab Limited, which is a listed entity. Okay, it's the same question. Actually, I have split it. It's the same test your knowledge question, which 2 points were discussed here. So again, they have discussed as an auditor, how do you draft the report if parent's auditor is also the auditor of all the components? The first point. Parent's auditor is not the auditor of all the components, SA 60600, and financial statements are not audited. So same points you are going to tell that you have to express an opinion whether it is true and fair view, P&L is true and fair, CFS is true and fair, cash flow statement. And when you are not the auditor, you need to tell how much is the rupee or percentage amount which you didn't audit. You have to state in other matter paragraph. And this amount should be calculated before giving the effects to the consolidation adjustments. And when you are not audited, okay, you have to get it audited. If not audited, you have to consider modification as per SA 705. It's not just modification, you have to look for quantitative and qualitative factors also, like what is the possible effect of not including the consolidated statement. Yes, test your understanding 3 question. Chitale is the auditor of CFS. Okay, with this only you understand, they are talking chapter 13. The consolidated financial statement consists of financial statement and information of 8 subsidiaries audited by other auditors. Such financial statement, financial information and auditors reports of subsidiaries have been furnished by the management of D and D Limited to him. Okay, chalo, we understood that financial statements and other information and audit report has been given to him for consolidation. Following further information is available in respect of subsidiary. Total assets is 1500, revenue is 1000, net cash flow is 10. Now, two of the subsidiaries are located outside India, which has been prepared according to the principles generally expected in that country, which have been audited by the other auditors. Okay, that means other subsidiaries, they only must have done the audit. But the two subsidiaries, they have done, audit has been done outside the India, generally as per the applicable, as per their framework. Where and how such information should be included in the independent auditor's report. Now, which information they are talking? They are talking about the information about the audit done by the, not by the principal auditor. Also draft suitable para by making necessary assumptions. So you can mark it as a priority one if this question has not come for the exam. Okay, now why they give you this information? Following information about 8 subsidiaries, they said total assets. Okay, but did they tell you which you didn't audit? Did they tell you the portion out of 1500 crore? How much is the percentage which you didn't audit? Did they tell? They didn't tell. So it's not possible for you to quote the percentage. So if the parent's auditor is not the auditor of all, you have to make a reference in the report or other matter paragraph and disclose clearly the magnitude or the portion. So stating the aggregate rupee or the percentage of the total. Okay, did they tell you that is it of 2? No, it is of all the 8. So you cannot tell the percentage here. In other matter paragraph, we should say that we did not audit the financial statement information of 8 subsidiaries. Okay, have they told you are not the auditor of all the 8? Yeah, correct. They told here only that information by audited by other auditors. Okay, so this is the information you may have to give. That you didn't do the audit of 8 subsidiaries whose total asset is 1500 crores, total revenue is 1000 crores, and net cash outflow is 10 crore. These financial statements have been audited by other auditors. Reports have been furnished to us by the management. In our opinion, CFS shows true and fair view is based on the reports of such auditors. 2 of these subsidiaries are located outside India, whose financial information and gap of the respective countries have been audited by those 2 other auditors in their respective countries. Management has converted the financial statements from GAAP to the Indian GAAP. That means they have gone for the second option. They must be having some group manual. We have audited the conversion adjustments. Okay, no, that means no, they have gone for the first option. Management have converted. This is a conflicting way of giving. So you can make any assumption that we have audited or they have gone the GAAP conversion. We have audited the GAAP conversion of the holding company management. Our opinion relates to the balance and affairs of the subsidiaries based on the report of other auditors and conversion adjustments. Our opinion is not modified because this is not a modification. We are just giving information that we didn't do the audit of so and so. Please write and practice this particular question if it is not come for the exam. See, it has already come for the exam. So please scrap. Not required. Is not a priority. This question came in September 25 exam and this was there sitting in your September 25 RTP. Beautiful, no students? March MTP you forget. Yeah, this question was already sitting in your test your understanding. And this was there in your September 25 RTP only. And that year only, it came in the examination, September 25 exam. That means if you have seen the RTP of that exam, yes, you will see one question which is very similar to that RTP. Now let us see in the RTP. I hope you are clear about this, how to draft. You are clear about every aspect. Okay, now let us see how they give this in the examination. Was somebody able to write that? Now, CES associates are appointed as the auditor for the CFS. Palm Limited, Rook and Bishop and Queen are the subsidiaries of King Limited. So you are the auditor of King. So there are 4 subsidiaries. The CFS consists of financial statements, information of this subsidiary audited by other auditors. So all these 4 are audited by someone else. Such financial statements, information and auditors have been furnished by the management of King to them. Now, see, they gave you total assets, total revenue, net cash flow. So what you need to do, you have to give the total. You have to tell. You can manipulate, you can change your audit report. You can tell the name of the subsidiaries also, respective amount also. or total amounts also. One such subsidiary, Queen, is located outside India, which have been prepared as per the accounting standard of foreign country. You are required to draft suitable para based on above independent auditors report. See, bumper. Huh? Only difference here is they gave you total amount here of all the 8. Here you gave the individual amount. So what do you need to do? You need to just make a total. Just to follow that. Whatever total are 300, 500, 900. Okay. So write 900. So this total you make and just give the way they have given in the RTP, give the same answer here. Now, so information to be included in case where the parent is not audited. So you have to give the emphasis other matter paragraph. You have to state that you didn't do the percentage and the rupee and the amount percent. You have to tell whatever they have told in the study material. Okay, now how you need to draft it? We did not audit the financial statement of 4 subsidiaries whose total assets is 900, total revenue is 1250, total cash flow is 45. These have been audited by someone else. Our opinion relates to the amounts and disclosure as per the report given to us by such auditors. Subsidiary is located outside India. Management has done the gap conversion. We have audited the gap conversion based on the report of the foreign auditors and conversion adjustment prepared by the management. Our opinion is not modified in respect of above work, and okay, in the Reliance and the report of the other auditors and financial statement and other information certified by the management. So clean bumper marks for this question. So this question you should search and write first. Question number 3. So definitely students, when you go through, okay, if you don't panic, definitely you will find many questions which you know very well. And perfection, 100% perfection is so not required only. They are asking only 50%. Let us target 60%. Followed, no? So this is all about your chapter number 13 called group audit. I feel it's very simple chapter. Okay, so any question comes, you can always address it.